As of the market close on August 10, 2026, Berkshire Hathaway Class B shares closed at $524.61, posting a solid gain of 0.83% during the daily session on an active volume of over 3.6 million shares traded. While retail traders across popular retail platforms were busy chasing volatile tech swings, Wall Street was quietly processing something far more significant inside Omaha's famous holding company. Most investors assumed that with Greg Abel settling into the chief executive seat after taking over operational leadership from Warren Buffett, Berkshire would remain stuck in defense mode, sitting on its massive fortress of cash and waiting for a major market crash. The prevailing expectation was that the massive conglomerate would continue its 14-quarter streak of selling off equities and hoarding short-term Treasury bills. The reality on the floor completely shattered that narrative. Instead of sitting idle, Berkshire just unleashed a massive $20 billion net buying binge in the equity markets, marking its most aggressive capital deployment in over 4 years. The company completely halted its multi-year selling pattern and went on an aggressive shopping spree, adding $10 billion directly to its position in Alphabet, while accelerating its own stock repurchases to $4.5 billion in a single quarter. When an entity controlling over $1.2 trillion in total assets suddenly flips the switch from cash preservation to aggressive buying, every serious market participant needs to stop and pay attention. Understanding this shift requires looking at how modern individual retail accounts interact with institutional giants. Whether someone prefers self-investing through the Robinhood app or relies on an individual brokerage account with Fidelity Investments, retail order flow during recent trading sessions was heavily concentrated in high-beta growth tickers like Tesla stock or Nvidia stock. Yet quietly sitting behind the scenes, Berkshire Hathaway continues to represent the foundational cornerstone for millions of long-term wealth portfolios. For anyone utilizing an intelligent portfolio service, Schwab Intelligent Portfolios, or exploring SoFi Active Investing, holding exposure to Berkshire is often viewed as the ultimate single-stock diversification strategy. When you examine the latest quarterly numbers, the underlying business momentum becomes starkly visible. Operating profits surged by 16% year-over-year to hit nearly $13 billion, easily beating consensus analyst projections on Wall Street. Total revenue climbed 10% to exceed $100 billion for the quarter, driven by strong operational recoveries in major non-insurance subsidiaries. Yet the market reaction has been surprisingly measured, creating a fascinating divergence between share performance and business reality. Year-to-date, Berkshire Class B shares are up roughly 3%, significantly lagging the broader S&P 500 index, which has gained over 13% over the same period. This underperformance has led many casual traders using online investing platforms or searching for quick investment help to assume the conglomerate has lost its edge without Buffett at the daily helm. That assumption fails to recognize what Greg Abel and Warren Buffett are actually doing with the balance sheet. While retail investors using interactive brokers trading or checking Robinhood stock trading feeds were distracted by everyday market noise, Berkshire was executing a calculated value strategy. The quarter saw BNSF Railway report a 6% rise in operating profits to $1.56 billion, driven by higher shipping volumes across consumer, agricultural, and energy lines. Berkshire Hathaway Energy saw its earnings jump 27% to $891 million as utility margins normalized and tax credits began kicking in. These industrial engines provided a massive financial cushion even as the insurance segment faced temporary headwinds. Underwriting performance at Geico showed notable friction, with pre-tax underwriting profit falling 45% due to an uptick in private passenger auto claims and higher advertising expenses aimed at market share acquisition. Wall Street analysts immediately labeled the insurance metric as weak, but institutional investors recognized that insurance float remains massive and highly cash generative. In fact, despite the heavy capital allocation into public stocks and private acquisitions like the $6.8 billion purchase of Taylor Morrison Home, Berkshire still closed the second quarter with a staggering $364 billion in cash and short-term treasuries. That cash hoard alone gives management unrivaled optionality to capitalize on any sudden economic downturn or credit market dislocation. Comment below how many shares of Berkshire Hathaway you currently hold across your investment accounts, or let me know if you prefer holding broad index ETFs instead. Taking a step back from the immediate price action allows us to analyze what Berkshire Hathaway actually is at its core. Founded originally as a textile mill in the 19th century, the company was transformed by Warren Buffett and Charlie Munger into the premier corporate holding company on Earth. Its business structure is split into distinct operating segments. First is the insurance group, anchored by Geico, General Re, and Berkshire Hathaway Primary Group, which generates billions in low-cost insurance float. Second is freight rail transport via BNSF, which operates one of the largest railroad networks across North America. Third is energy and utilities through Berkshire Hathaway Energy, supplying power across multiple states and international territories. Fourth is manufacturing, service, and retailing, covering everything from industrial components, aerospace systems, and home construction materials to iconic retail brands like Fruit of the Loom, NetJets, Pilot Travel Centers, and McLean Distribution. Layered on top of these wholly owned operating businesses is Berkshire's world-famous equity portfolio. Over the decades, the equity investment strategy focused on durable competitive moats, pricing power, and strong capital discipline. Today, Berkshire holds massive core ownership stakes in consumer titans like Apple stock, major financial institutions such as Bank of America, and global consumer staples like Coca-Cola. Whether investors manage their wealth through Fidelity Brokerage, Fidelity Wealth Management, SoFi Stocks, or an interactive broker's account, studying Berkshire's equity portfolio remains a primary tool for tracking institutional smart money movement. Looking ahead toward the future outlook, the expectation versus reality dynamic will define Berkshire's trajectory. The expectation is that without Warren Buffett running the daily investment show, Berkshire will gradually trade like a slow, bureaucratic utility index with limited upside potential. Investors worry that the sheer size of the company makes beating the broader S&P 500 nearly impossible over the next decade. However, the emerging reality under Greg Abel tells a completely different story. Abel has demonstrated that he is not afraid to deploy tens of billions of dollars when valuations align, breaking a 14-quarter drought of net selling to scoop up tech leaders and home builders at favorable entry points. Furthermore, the buyback acceleration proves that management views its own stock as one of the most attractive risk-adjusted options on the market. If broader macroeconomic pressures, high interest rates, or geopolitical tensions trigger market volatility, Berkshire's $364 billion cash reserve positions it as the ultimate buyer of last resort. While self-directed investors using investing sites, SoFi Robo-Advisor, Fidelity IRAs, or Robinhood Cash Management react to daily headlines, Berkshire is uniquely structured to turn market chaos into long-term compounding. In summary, the popular market narrative painted Berkshire Hathaway as a stagnant giant holding too much cash and suffering from leadership transition inertia. The deeper operational reality shows a 16% surge in operating profits, aggressive share repurchases, and a bold return to net equity buying with $20 billion put to work in high-conviction assets. As Greg Abel continues to establish his operational identity while keeping Warren Buffett's foundational philosophy intact, Berkshire Hathaway remains a titan whose fundamental financial strength consistently outpaces casual market expectations.